So thanks everybody for joining us today for the Lakeside Chats. We have Dave Keib with us here from American Funds. And Dave's been with American Funds for 7 years, and he's from Saratoga. And he's gonna today talk to us about the election and maybe what we can expect or what has happened in the past that might give us a little bit of insight into what's going on. So take it away, Dave.
Great, thanks, Adam, and Heidi. Thanks for having me tonight. We greatly appreciate the invitation to address you folks, and thank you all for taking time out of your schedules to spend a few minutes with us tonight. I promise I will get you back to whatever it was you're doing. I will tell you very quickly that I have 2 little ones, so if you happen to hear screaming in the background, you're getting very close to dinner and bedtime. So my wife's on that duty while I am in my office here. I will tell you the door is closed. But that doesn't mean anything for a 4-year-old and a 16-month-old. So just keep that in mind as we run through here. Aside from that, though, it is a pleasure to be here, and I'm looking forward to our time together. And then finally, just a little bit about me. Adam mentioned 7 years with the American Funds. Prior to that, I was with 2 other asset management companies, so just shy of 15 years in the industry as a whole. My job, so you understand completely what I do, is I'm essentially the liaison between our portfolio managers, our analysts, our economists, all those really smart folks, way smarter than I am, and financial advisors like Heidi and Adam and Christina, and quite frankly, advisors all over upstate New York. Adam mentioned I live in Saratoga, but I work with financial advisors all over upstate New York. And my job is very simple, to communicate our thoughts, what we're doing, what we're seeing, how our portfolios are working out to financial advisors and to you folks, to clients. So essentially try to communicate the best I can where the risks are in the world today, where the opportunities are in the world today, and hopefully be able to do that with some semblance of coherence. And that's the idea for tonight's presentation, right? So just to give you a little background on what we're thinking about the election, what we've observed. Number one, and I think we'll break it down in 3 parts just to keep it very simple. So number one, we'll look at, historically speaking, presidential elections and what have they meant for investors. All right, so we'll put that historic lens on first. The second thing we'll do is we'll look at investing in election years. So investing in presidential election years is actually different than investing in non-presidential election years. More to come on that in just a minute. And then finally, we'll look at investor behavior in election years, the one that always is very interesting to me. So those 3 quick bullet points here in the next 15 or 20 minutes, then we can open it up, Adam, for questions. However you'd like to handle that, it's up to you. And then hopefully you are all off to a good evening and some dinner as well, because that's what I'm definitely looking forward to as well. So let me, bear with me here as I share my screen with you. Hopefully this works. 9 times out of 10 it does, but there's always that one chime that it doesn't, and that seems to be hopefully not happening here today. So far so good, Adam. Awesome, I got a thumbs up, so that's a very good thing. I would love to make this a little bit bigger, which I can do in a little bit. All right, so let's tackle that first objective. Let's take a look specifically at a review of U.S. presidential elections as far back as we can and see what we can learn. So the first thing I'm going to do is zoom in so y'all can actually see. I mentioned, and if we were in person, I would quiz you all, but we're not. So I'm going to give you the answer to the quiz. When we were founded as a company, and the answer to that question was 1931. So we have actual data that we can point to all the way back to 1934 on how our investments have performed. And in particular, for our conversation tonight, we can talk about how our investments have performed in election years. So you'll notice the data that I'm going to share with you today dates all the way back to 1936. And what I'm going to do here for you in just a couple seconds, and not too lengthy, but just to give you an idea of what you're looking at here, we've highlighted, taken the liberty of highlighting the winner of every single presidential election that this fund has been around for. And we've also highlighted the challenger and the main issues that were at hand during that election year. right? So if we kind of went through this, you will see obviously some blue names, which is representative of Democrat, some red names, which is representative of Republican, vice versa, so on and so forth. And here we are essentially today. All right, so let's take a look at some investments during these election years and how they've done. Now, the first thing that I want to highlight, okay, is we're not looking at specifically yet what happens to investments in election years. We're thinking about things from a slightly longer term perspective. I'm going to venture a guess that many of you are investing for things that are out in the horizon a little bit, whether that be retirement. And even if you're in retirement, you're actually probably investing for the longer term, or again, a second home, kids' education, whatever it means. These are generally speaking what we would call long-term goals. So looking at how things do in a single year is pretty irrelevant. We want to think about things from a longer-term perspective. So what we did here is we looked at how an investment would have done if you were to invest in the election year itself.
If you were to invest
a little feedback here.
In the election year itself. A little feedback here.
Adam, can you mute everybody's line? Perfect. I think we're better. I don't have the feedback anymore. That's good. I don't know if anybody else heard that, but it would have bothered me for the next 10 minutes for sure. So we, again, are going to be looking at specifically how we would have done if we did invest in an election year. Again, remember, investing in an election year is different than investing in non-election years. More to come on that. And we held that investment for a full 10-year period. So for example, if we go back to 1936, we are assuming a $10,000 investment, and how that did, okay, over the next 10 years. So we invested in 1936. We held the investment through 1945. That's how to think about that first example. So your $10,000 in that time frame would have grown to $27,000, and your average annual return would have been 10.7%. We do that for every single presidential election. And again, your key, right? Blue is when a Democrat won. Red is when a Republican won. And as I kind of scan through this, and I'll do it rather quickly because we don't need to know every single number, but you'll notice a few things, right? You'll see some blue, you see some red, you see some return numbers, and you see some return numbers that are higher and some that are lower, et cetera, et cetera. If I scroll down to this page, you're going to see the same exact type of story, starting now here in 1980, 84, 88, et cetera, et cetera. Now we're in 2000, so on and so forth. Okay. Now, I did it very quickly, but I'm going to ask you to guess, and again, rhetorically, because we are not in person and we don't want that feedback issue again. But I'm going to ask you to guess what the best 10-year period, right? What election year in the following 9 years was the best 10-year period to be an investor, and what was the worst? I'll give you a second to think about it. I'll also give you a massive clue is that it's on this page. Both of the answers to that question are on this page. So very quickly after that clue, you'll be able to pick out that the best 10-year period for an investor investing in election year was 1980 with Ronald Reagan. Your $10,000 would have grown to $53,000 and change, and you had an annualized rate of return of 18+% during that time frame. Your worst 10-year period was the year 2000 through the year 2009 with George W. Bush. $10,000 only grew to $13,000. Your average annual rate of return was 2.7%. Now, why do I point these two things out to you? A couple of reasons. Number one, I had you visually look at all of those numbers very quickly, to be fair, to notice, at least I can't figure out, any type of trend or predictive future based on a blue number versus a red number, right? Almost impossible, again, if I threw them all out there for you, to pick out any specific trend, right? And that's the number one question I can tell you I get, and I can almost guarantee it's the same thing for Heidi and Adam and Christina, is when does the market do better? When there's a Democrat in the White House or a Republican? And the answer is, it doesn't matter, right? What matters much more and you'll see where I'm going with this in a second, is think about what happened, the events that we dealt with as investors from the year 2000 through 2009. Dot-com bubble burst, 9/11. Oh, and this little thing called the Great Financial Crisis, right? So much bigger than who was in the White House, or who wasn't in the White House for that matter, were the events of that time frame, the economy of that time frame. How is that doing, right? Now, back to 1980 in my example there. Again, I don't think, our humble opinion, you can point to a specific party or president taking advantage of an 18% rate of return. We'd much prefer to point to demographics with the baby boom hitting the workforce and increasing our growth in GDP exponentially for the next 10 years. Our opinion, a much bigger reason for that return that you see there versus a political party trying to take advantage or not take advantage of that opportunity, right? So the point of it is, and this is hopefully we'll sum it up for you on this page, and I think this is maybe even a clearer way to do it. I'll zoom out so everybody can see this chart. Here on one page is an illustration of those 22 different elections. I'm sorry, the 19 different elections that we're actually looking at here, okay? And again, red for Republican, blue for Democrat, and I will give you every dollar in my wallet right now if you can pick out or pinpoint some type of formulaic answer to when the market's going to do better when there's a Democrat or a Republican in office. There's just no pattern that we can identify with any sort of certainty, that's for sure. So that's the review of the U.S. presidential elections. The last thing I'll point out before I leave this chart is if we go back to that worst case scenario, which I will do for just very quickly here, that worst case scenario of 2.7%, that was the worst we've seen in every 19 one that we've actually looked at. That 2.7%, folks, I don't know about you, but if I was to go and shop any savings account, CD, money market out there, I would be lucky to get 0.7%, never mind 2.7%. So from a relative perspective, I think we got to keep that in mind, that our worst case scenario that we've ever seen with those events that I mentioned before is still better than what we can do right now in trying to get something and putting it under the mattress, quote unquote, or in cash and earning a very, very low interest rate. That's the review of presidential elections. Let me hop on to item number 2, which is where we're going to look at specifically investing in election years. Okay. So hopefully you can all still see my screen. I did change the slide deck just for a second there. Adam, thumbs up or head nod. Perfect. We got that. Excellent. Thank you. So now we are going to look at specifically what happens to the stock market during election years. I've said it twice. I will say it again. Investing in election years is different than investing in non-election years for a couple of reasons. So first off, if you take a look, and bear with me, I'm going to walk you through this chart. It's not the most intuitive, but you'll get it in a second. What we do since 1932, remember, we were founded in 31, so that's as much data as we actually have. Since 1932, we're looking at the S&P 500, which of course is the broad U.S. stock market that everybody refers to on a daily basis. And we look at how that S&P 500 stock market has done historically in non-election years. That's the blue bar, the dark blue bar, or line, excuse me. And how the S&P 500 has done during election years. That's the lighter blue. And of course, we're all going to start at the same point, January 1st. And what you see is rather interesting, right? You see a trend in non-election years that moves up pretty significantly in the first 3 months and then really takes off once we get past that first quarter and into the second quarter. And the reason for that is, historically speaking, that's generally speaking where we're getting some retail numbers around Christmas time, and if they were good, we can carry that momentum into the second quarter, and it really takes off for essentially the rest of the year. Now, the interesting thing is, if you've ever heard the expression sell in May and go away, it's essentially where this comes from. In non-election years, the vast majority of the return is gained in that first 5 months. Kind of interesting. Election years, a very different story. You start at the same point, but there tends to be a heck of a lot more, that word, the V word, volatility, right, in that first 5-month period, and pretty significant in this kind of April and May-ish timeframe, right? If there's one thing that we know for sure, is that the market hates uncertainty. And when are we most uncertain around an election? It's during primary season, when one of two things is happening. Either the challenging party is figuring out who the nominee is going to be to represent their party to challenge the incumbent, or even worse, both parties are trying to figure out who the nominees are going to be because we have a lame duck in the office that time around. Markets do not like that uncertainty, hence why you see this trajectory in the primaries of going down versus actually going up. Now, the interesting thing is that downward movement, that volatility or price fluctuations, okay, the majority have happened in election years in the primary time frame, which, since we're October 27th and 1 week away from Election Day, would assume the fact that we've actually gone through the worst part of the volatility, historically speaking. Now, I'm not going to say that there's not any as we get closer to Election Day, because this chart even shows it, but the worst of it is definitely behind us, at least historically. And we would argue, especially this year, combine COVID with the election, and we've had quite the tumultuous first and second quarter. Now, the last thing I'll mention on this chart is, as I referenced before, in non-election years, there tends to be a lot of the return for the year accumulated in that first 5-month period. It's the opposite in election years. So if you were to look from a May to May perspective, I know it's weird, but it kind of works. Let me explain for a second. From a May to May perspective, so we cut it off here and we look from May 31st in the election year to the following May 31st after the election year. In non-election years, your average return is 5.6% in the S&P 500. In election years, it's 10.2% from that May to May timeframe. Kind of interesting. Last point, and we'll open it up for some questions. Let's look at investor behavior. So the very next couple of pages dedicated specific to what investors do, their behavior during election years, and does it work? So what we did here is we're looking, this is the entire industry, and we're looking at where investors are putting money from 1992 through the end of last year. And we're breaking those years down into fours. So the first year of a presidential, after the presidential election, the second year, the third year, and then of course we come up to election year again, right? So that's the way to read that chart. And what you see is in the first 2 years, the vast majority of investors are putting their money in the stock market, in what we call equity funds, that blue line. Some are still putting their money in money market funds, which is a cash alternative, right? Safety. But as we get into that third year, that gap narrows pretty significantly. Still slightly more into stocks than into cash. But that actually inverts once we get into the election year, right? So if you've ever had the temptation to call up Adam, Heidi, or Christina and say, hey, I think it's a good idea to throw our money in cash and see how this thing kind of plays out, you would be one of those people that is contributing to that green line. Let's see if that was the right behavior or not. So now what we're going to do here is look at 3 different ways to kind of play elections, 3 different ways to invest. This first blue line says you are a fully invested individual, right? You didn't do anything from the election day, from January 1st of the election year. You stayed fully invested the full 4 years through, right? The full 4 years after the election, you stayed fully invested. The second one, the blue bar, is if you still happen to be in the accumulation phase of your life and you're working and you're contributing to a 401k, we're attempting to illustrate that, right? So we're attempting to show an investor who's putting in $1,000 every single month for the first 10 months of the election year and then holding it all the way through the end of that 4-year period. And then finally, we're showing this red bar is someone who's saying, all right, I'm going to sit on the sidelines for this election year, okay? And I'm going to put my money into the stock market after the election's over on January 1st, following the election year, okay? And we looked at 22 different election cycles since 1932, and we've identified that staying in fully invested was the best outcome of the 14 of the 22 times. Sitting in cash in the election year and then investing after the election is over was the best outcome only 3 of 22 times. So let me recap and we'll open it up for questions. So we looked at past presidential elections, right? And hopefully you saw the same pattern that I did, i.e. there wasn't one, as to who does better, when do investors do better in the stock market when there's a Republican or a Democrat in the White House, right? Very hard to predict that, much more based on the environment that we're currently in. And to steal a line from one of those presidents, you probably know who it is, but it's the economy, stupid. Remember that one. Second thing, we looked at how the stock market actually behaves very differently in election years versus non-election years. Key takeaways there, right? The majority of the volatility or that price fluctuation that we see in the stock market happens during primary season. It's behind us. Yes, we can anticipate some more as we approach election day, but that's completely normal. And the following May is really when we start to take off from an election perspective versus non-election years. And then finally, we talked about investor behavior, on how people are very apt to put money into the stock market year 1 and year 2 of a presidential cycle. Year 3, not so much, and definitely not so much in year 4. And then, of course, was it the right call? Well, yes, it was the right call to put money into cash in those election years for 3 of the 22 periods that we looked at. It would have been much better, at least the odds would have been in your favor, 14 of those 22 times to stay fully invested. So Adam, with that, I will pause and see if there's any questions.
All right, so everyone, I just kind of muted you while we were having some of the feedback issues, but feel free to unmute yourself if you have any questions for Dave or myself or Heidi, for that matter. Or Heidi, if you want to contribute to the questions, you're on this side of the table, whichever one you want to do. So feel free to unmute yourself, raise your hand, whatever works for you if you have a question. So I'm not seeing many questions, but I actually have a question, Dave. I'm wondering if historically it looked like when you were showing the slides that it seemed to the market seemed to pick up after the election, or if the volatility seemed to decrease. Is that seemed to be right in year 1 after the election, or was it somewhat of a muted thing?
Yeah, it's a good question, Adam, and I think you're spot on, number one, and perceptive. You definitely do see, and I can kind of go back to the chart so everybody can look at it together, so bear with me while I pull that back up here. And there we are. So here's election day, right? And again, we see kind of this leading up to it, these little spikes and up and down, and that's that volatility that we kind of keep referring to, right? And then once we kind of hit election day, you'll notice that trend kind of continues to move upwards. Of course, there's some little movements here, but that trend is pretty up to that northern eastern quadrant, which is kind of where we want it to be moving. And then again, once we get into the next year, and this is where the differences kind of come in, we start to see some muscles being flexed as far as policies go, and maybe some potential changes. And we get a little bit of consternation from investors. But again, we seem to kind of pick back up and move on from there. So historically, that's the trend. Of course, every single year doesn't work exactly like this. But if we can learn anything from history, I think it tells us that these elections years do tend to be volatile. But there is usually a rainbow, a pot of gold at the end of that rainbow if we're willing to be patient.
Sure. Yeah, it just seemed like to me that made sense when you think about everyone kind of breathing a sigh of relief. At least they know who is elected at that point. And then, you know, they can start thinking further ahead when you look at second quarter, that kind of thing, what policies might be put into place and along those lines.
Heidi, did I see your hand?
Yes, I just wondered if there was any, this is pure equities, correct? This is pure stocks.
That is correct. Yep, that's the S&P 500. That's all we're looking at there.
Okay, so it's both value and growth. There was no breakouts of growth versus value. So bottom line is a mixed blend because it changes.
Exactly. As you know, these things tend to work in cycles. When growth outperforms value, value outperforms growth, et cetera, et cetera. So yeah, we just use the S&P 500 as a composite to use a blend.
And there's nothing about foreign, and there's nothing about small caps or mid caps.
So no, in the analysis that we did specifically, obviously, since we're talking U.S. elections, we decided to keep it specific to the U.S. stock market, and obviously the S&P 500 is what everybody thinks of as the U.S. stock market. I will tell you, and I'm not telling you anything you don't know, but historically speaking, you tend to see small caps do slightly better than large caps over longer periods of time. And I would venture a guess, and it purely is a guess because I don't have the data in front of me, that you would see this, if we did this for small cap U.S. companies, it would probably be even more volatile because they tend to be. And then that recovery and moving upward would probably keep that trend and even move up a little bit quicker. International markets is an interesting one. I could see that going a whole host of different ways, quite frankly. So I don't know the answer to that question, but it's an interesting one.
Cool.
Great. Well, I'm not seeing any other questions from everyone. If you do have a question, you can feel free after the presentation. If you want to send myself, Heidi, or Christina an email, we can definitely answer your question or pass something along to Dave if there was a chart that you wanted a little bit more information on. But you know, I really want to thank Dave for all your help and kind of walking us through some of the historical stuff behind the elections that seems to kind of mystify everyone when it comes election time every 4 years. You know, what's going to happen? What did it look like before? I think all your comments and illustrations have been very helpful.
I agree with that. And there's so much polarization this year, more than ever before. It's kind of, you know, people can't respectfully agree to disagree. It's a shame. And then people, I think, are even more frightened. You top it off with COVID, and then you get in elections. People want to do the right thing. And I think sometimes not doing anything is the right thing. You've really got to weigh everything. And this is helpful because I think a lot of people I get the questions a lot, you know, do I hold off till after the elections? Should I sell before? Should I buy after? The same things that you're saying. And your perspective on history, I think, is most helpful. Kind of tells us what's happened in the past. And as we know, it's no guarantee of the future. And you always have different circumstances, but I think it's great.
Awesome. Well, it's my pleasure. My pleasure, Heidi. Adam, thank you for moderating tonight. And thank you all for joining us. Promise to get you out of here in a timely manner. And I think we've accomplished that mission, hopefully with a little bit more knowledge than we came just a half hour beforehand. So thank you all for joining us. We greatly appreciate it. Hope you all have a great evening.
Thanks, Dave. Thanks, everybody. Good seeing everybody.
Tuning in.
Thank you.